Hi, I'm Chris Lioutas from PSK Private Wealth, here to give you another market and economic update. The outlook for the global economy has been changing at a rapid pace over the last 6 to 9 months, which is very interesting because generally when we see outlooks provided, they tend to not change that frequently, particularly when you're thinking about a 12 to 18 month outlook. And the reason for that is that this has been an unusual period in terms of interest rates going from very low levels to very high levels very quickly, and also a period of very high inflation, which we haven't seen for some time. So it has created volatility both in markets and in relation to forecasts and projections. If we wind back to earlier this year, there was a bit of optimism that we may be able to get through the next 12 months without a recession. And then we fast forwarded through to March and April where we saw US banking issues and European banking issues, and it brought recession risks to life. It made them real. And markets got very concerned very quickly, and so did economists in terms of their forecasts, with a lot of people penciling in recessions for the US economy and other economies globally. If we look at the last couple of months, what's happened in the last couple of months is people have become much more comfortable with the outlook. And the reason for that is that we've seen inflation fall at a much faster pace than previously thought, and we've seen central bank commentary sort of start to indicate that they're done with their rate hiking cycle or their tightening cycle. So it's provided some confidence and some clarity around the forward period. And so what we expect in the forward period is weaker economic growth, weaker than the 2 years of COVID, where we had exceptionally high growth due to stimulus, and likely weaker economic growth than we saw pre-COVID as well. And so that might feel recession-like for some parts of the economy and for some households, but it's unlikely to be a deep and prolonged recession as may have been previously worried or concerned about. Within that outlook, though, it means some added volatility in markets, given we think the forecasts are likely to change again over the next 6 to 12 months. And so we're watching it very, very closely to see how portfolio positioning may need to be adjusted as both risks and opportunities arise. China's economy is a hot topic at present, and the main reason why it is it's the world's second largest economy. It's Australia's biggest trading partner, so it's always going to be front and centre when things aren't playing out the way they're supposed to. And that really comes down to the fact that China reopened post-COVID in November last year to a lot of fanfare and a lot of optimism. And that has since waned. And the main reason for that is we've found that confidence and sentiment at the household and small, medium business size level have been waning and getting worse. The gist of that is that historically, when that has happened in the Chinese economy, the Chinese government has provided significant amount of stimulus to try and patch over or fix those issues. And what's been made clear by the Chinese government over the last few years is that they're unlikely to provide those level of stimulus packages again. And so, whilst the Chinese government is coming to the party providing small levels of stimulus, or small amounts of stimulus, that means you're going to have a prolonged reopening exercise or a prolonged economic recovery exercise. So we're talking a 2, 3, 4 year event, rather than the quick sudden reopening that we saw in Western economies. The problem is fixable, but it is a big problem given it's the world's second largest economy. They've also got a property market that has collapsed, that needs to be fixed. And the problem with the property market collapsing is that the quick fix is to rectify and get house prices rising again, but that doesn't necessarily solve the problem of undersupply, housing affordability, and a whole range of other issues. So there's a complex set of problems the Chinese government's working towards fixing and resolving, but it will take some time to fix those problems, whilst Western economies and Western markets become increasingly impatient with the time it's taking to fix. Once they get consumer confidence and sentiment higher, we think the economy will start to recover, but in that period it will remain lackluster in terms of economic growth versus expectations. We think the problems are fixable, we think they're solvable, we're watching it closely. At the moment we think it presents an opportunity rather than a risk, but we are watching it closely both from a China domestic consumption story, but also from a foreign store perspective as well, in terms of Australia's biggest trading partner, and also in terms of foreign flows of capital. A lot of the Chinese equity market and asset prices are boosted by foreign flows of capital, and at the moment they're very, very weak versus historical periods. So we're watching a whole range of things in relation to China, not necessarily just reading the headlines, which will make you believe the economy is about to go bust, and seeing it more from an opportunity perspective rather than a risk perspective. But that may change over the next 6-12 months, depending on what the Chinese government does with stimulus and how quickly they can get confidence up both at the household level and the business level. Inflation definitely has peaked, and that has been confirmed by a variety of sources. And there's two things to note in terms of inflation peaking. One is where inflation was, and two is where it's heading. So in terms of where inflation was, it was very high for the last 12 months, and much higher than we've seen it for some time. And if you look through historical context, it does take time for inflation to fall from those levels back towards target. So in the Australian context, it's 2 to 3% over a period of time. In the US context, it's 2%, a hard and fast number. So we have seen inflation fall over the last 6 months, and it's actually fallen at a much quicker pace than we previously expected. If we look at where inflation's at today in most jurisdictions, it's at levels that we expected to happen at the end of this year, and they've largely come about at the middle of this year. So it has fallen much quicker. The concern at the moment, though, is that it gets stuck at these sort of levels. So it actually doesn't continue falling to sort of target levels, so 2 to 3% in Australia's context or 2 in the US context. And the main reason for that is there's a range of external factors which weren't present pre-COVID that are now creating inflationary aspects. So they include things like the Russia-Ukraine war as it impacts energy prices, labour shortages, the cost of labour, the free movement of labour across borders, cost of production, some supply issues, and a range of other factors that are providing some support for inflation. And so whilst that's not always bad, it is critical to note that there is a risk that inflation does take off again from here. And so central banks need to be very mindful of that and need to be very hard and fast around their concerns around inflation to make it clear that they're still fighting inflation. They still want to bring it back to target. They remain committed to bringing it back to target. So yes, the easy wins have been had on inflation, on bringing it down, largely means central banks are comfortable with where inflation's at, but the fight is not over yet. They still need to hit those targets to maintain their credibility and make sure that the economy is growing thereafter. We think the central bank outlook is probably more clear than it has been for some time. And the main reason for that is that they've done a lot of the heavy lifting already. So they've gotten rates to very high levels, and what they've caused is contraction in the economy, which has seen inflation fall from very high levels to much more amenable levels. Inflation is still not in target or at target, and so that there's still some work to be done. And so central banks are playing a bit of a balancing act between obviously not crushing an economy or forcing an economy into recession, but also remaining steadfast in their approach to getting inflation under control and back to target. And they need to do that to maintain their credibility. If they lose that credibility, it creates problems for asset prices and markets. If we see the last couple of months, what we've seen from central banks is a fairly degree of talk around their comfort levels in terms of where they've landed, and no real push to raise rates significantly from here. So we think most central banks are probably done at this point in terms of their rate hiking cycles. Where there has been some change in the last couple of months is really around what they plan to do over the next 12 months. And if you look through previous rate hiking cycles, what central banks have done historically is they've raised rates to too high a level and then had to slash aggressively over the course of the next 12 months. And it looks like they've stopped short of causing economic destruction, but at the same time, we haven't got inflation back to ban yet. So the talk over the last month or so has been really around likelihood of keeping rates higher for longer. Higher for longer is the mantra being used, and that's where we see rates stay at these sort of levels for the next 12 months. We might see some subtle adjustments over the course of 2024, but no significant slashing of rates through that period. So we think that that's the outlook right now. But obviously, we're watching their rhetoric closely. We're also watching inflation outlook closely as well, and that may change over the next 3 to 6 months. But for now, we think they're done. We think they're comfortable with what they've achieved, and that the higher for longer rate mantra we think is definitely in play. Thank you for joining us on another market and economic update. We look forward to seeing you next time.